Hello guys, welcome back to another things. But for today's video, we're going to show you or discuss with you TLT ETF Explained. So, you might be wondering what exactly is TLT. Well, TLT stands for the iShares 20 Plus Year Treasury Bond ETF. Now, at its core, it's a fund that gives you exposure to long-term U.S. Treasury bonds. Now, we're talking about government debt that matures in 20 years or more. You're not buying bonds directly here. Instead, you're buying shares of an ETF that holds a big bundle of these bonds for you. And it's like taking a shortcut into the long-term bond market without needing to mess with the paperwork or buying individual bonds yourself. Now, why do people buy it? So this ETF is popular with investors who want stability, especially during economic slowdowns. Since US Treasury bonds are backed by the government, they're considered one of the safest types of investments out there. TLT lets you tap into the safety net while still being able to trade it like a regular stock. Here's the interesting part. TLT isn't just about safety, it's about strategic tool. Its price is very sensitive to interest rates. So if interest rates fall, the price of the bonds in the ETF goes up, which means TLT goes up too. If rates rise, the opposite happens and TLT value drops. So if you're expecting interest rates to go down, buying TLT could be a smart move. Now, in this case, when is it actually useful? So when TLT really shines here is during market volatility, when people pull out of the stock and seek safety, and when the economy slows down and the interest rates are likely to fall as well. And as a portfolio hedge, to help balance your riskier assets like tech stocks or crypto. So also, if you want a way to bet on bond prices rising without buying bonds yourself. Now, what's the catch here? So the TLT might sound super safe here, and it is in terms of credit risk. There are still trade-offs here. So first is interest rate sensitivity. So since it focuses on long-term bonds, it's especially vulnerable to interest rate hikes. Even a small increase in rates can cause a sharp drop in TLT's value. Now, also, there are inflation concerns here. So, treasury bonds pay fixed interest. So, if inflation is rising, that fixed payment loses real world value. You're basically earning less in terms of what your money can actually buy, and also low yield. Now, because it's made off of government bonds, the regular income from TLT tends to be lower, and then that you'd get from corporate bonds or dividend-paying stocks. You're trading higher returns for more stability here. Now, if you're looking for low risk, interest rate sensitive investment that can protect your portfolio when markets get shaky, TLT is worth considering here. So it's not a growth play, it's more of the defensive tool. Use it when you expect rates to fall or if you want to reduce volatility in your overall mix of investments. But that's about it. Hopefully, this video was able to help you like and subscribe to NF Info. Thank you for watching.